Welcome to Fairport Flash, the monthly economic update powered by the Fairport investment team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Welcome to this month's edition of Fairport Flash. My name is Rick D'Amico, Manager of Investments at Fairport Wealth. As a member of the investment team, I'm primarily responsible for managing the firm's fixed income and liquid alternative investment strategies. I hope everyone is doing well and staying safe this holiday season. So let's get started. With the election now mostly behind us, I'd like to focus on some of the positive developments we've seen in both the economy and the equity markets over the last couple weeks. Let's begin with the economy, where we've been seeing several signs of improvement as it pertains to fourth quarter GDP growth. Evercore ISI recently increased its U.S. real GDP growth estimate from 4% to 8%, and the Atlanta Fed GDP now estimate is close to 11%, fueled by a slew of strong economic data, which we will cover in a minute. We've also seen a three-quarter record increase in consumer net worth, driven by both rising stock prices and rising home prices. Consumer net worth has increased 18.6%, or almost $21 trillion over this period. This is important because historically, consumer net worth has been a reliable leading indicator leading U.S. real GDP by 6 months. In a recent report, Evercore ISI also cited 7 blowout economic reports that have hit, highlighted by its strength in both housing and employment. Existing home sales were up 26% year over year in October, while existing home prices increased 15.4% year over year in October. Housing is another important indicator to keep an eye on, as it often has large ripple effects throughout the economy, creating spending on appliances, furniture, landscaping, and painting, among other things. The employment rate was also down 100 basis points month over month in October. The last time the employment rate dropped over 100 basis points month over month was in 1949. And in addition, the employment PMI hit a record high of 57.4% in November. Another key indicator we like to keep an eye on is Evercore's ISI Trucking Survey, which surged 2.5 points last week to a near record level of 67.3. We follow this survey closely since it has the highest correlation to U.S. real GDP growth of any single survey sector that Evercore ISI tracks. Another key to the recovery is the unprecedented intervention by central banks across the globe. To say central banks such as the Fed, the Bank of England, the European Central Bank, and the Bank of China have been accommodative is an understatement, as their balance sheets have ballooned almost 70% over the last year to $17 trillion. Monetary stimulus, which typically works with a lag of 6 to 12 months, is likely to be supportive well into the first half of 2021. Evercore ISI actually tracks each monetary stimulus measure across the globe, and the count is currently at an astonishing 640 stimulus initiatives in the last year, with number 639 being the Fed's signal of stronger QE guidance at its December meeting. Next, let's look at corporate profits. After a third quarter surge in corporate profits, Evercore ISI is now forecasting S&P earnings to be even stronger than it had expected in Q4, driven by the stronger than expected GDP growth we discussed earlier. As such, they have increased their S&P earnings estimate to $165, up from $160. Remarkably, after a strong third quarter, corporate profits have now rebounded all the way back to their 2019 peak. We've also seen a lot of positive news on the vaccine front. Moderna's results from its phase 3 study were extremely encouraging, proving to be 100% effective in preventing severe cases of COVID-19 in its trials. The difficult period, of course, will be getting from now until then, especially with the recent spike in cases and current stresses on our healthcare system. If all goes well, according to Goldman Sachs, large populations of the developed world could be vaccinated by the second quarter of 2021. Successful vaccines could help spur an unprecedented synchronized global rebound, but most importantly, will save lives and help us get back to some sort of normalcy with our family and our friends. There are some indicators that are a little less optimistic on growth. For example, Evercore ISI's company surveys are a little more subdued and are tracking Q4 growth in the 3% range. And as economist Ed Hyman points out, the economy is very bifurcated, with parts of the economy surging and other parts getting hit extremely hard. An example of this is on one hand, you have a giant like Amazon adding over 427,000 employees in the last 10 months. And on the other hand, a company like Disney announcing that it's increasing layoffs to 32,000 workers as they attempt to cope with the devastating consequences COVID has wreaked on its theme park business. To this point, it appears that the surging parts of the economy have been strong enough to outweigh some of the sectors that have been really struggling. But sadly, it does appear as though parts of our economy, especially in the retail space, could be permanently impacted. For additional insight, we often look to the credit market for signs of underlying stress. Credit spreads, as represented by the BAA spread, continue to grind lower. Tightening credit spreads are a signal that the economy is continuing to improve. BAA spreads hit another recent low of 231 basis points, significantly down from pandemic levels when they were north of 400 basis points, and they are continuing to grind tighter. So where do we stand with the markets? There's no doubt that the recent hot streak in economic data has propelled the market in recent weeks. The Dow is coming off its best month since 1987. Of course, the challenge always lies in determining how much of this good news has already been baked into the market. According to technical analyst Jeff DeGraff of Renaissance Macro Research, elevated sentiment is the market's biggest obstacle, with the bull-to-bear ratio at the highest level we've seen since 2018. That being said, DeGraff believes that the strong trend in equities and recent momentum thrust should win out, and that any negative response to sentiment could be short-lived and viable. So in summary, there's been a number of positive signs regarding the economy. We discussed quite a few, but there were almost too many to list, which is a good thing. And while we've seen a lot of strength in equities over the last month, the strong trend remains supportive, and we are in the middle of what is typically a strong period seasonally for equity returns. We can understand why investors may be cautious given the recent strength we've seen in the markets, but we remain optimistic, especially given some of the strength we've seen in leading indicators for the economy. Low inflation and low interest rates have historically also justified equities trading at higher multiples when compared to their longer-term averages. This brings us to the conclusion of this month's Fairport Flash. As a reminder, our goal at Fairport centers around inspiring families, and as a member of the investment team, we strive to do this through a long-term diversified approach. If you would like to discuss any of today's topics in more detail, please reach out to your Fairport team. Thank you for listening. Happy holidays. And keep an eye out for the next Fairport Flash in about a month.
Fairport is a group of investment professionals registered with Hightower Securities, LLC, a member of FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinion, news, research, analysis, prices, or other information contained in the research is provided as a general market commentary. It does not constitute as investment advice. Fairport and Hightower shall not be in any way liable for claims and make no express or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements and errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Fairport and do not represent those of Hightower Advisors, LLC, or any of its affiliates.